Good afternoon, everyone, and welcome to our next session with Lake Resources. I'm Joe Fars, Director of Investment Banking here at Red Cloud, and I'm joined by Stu Crow and Steve Promnitz from the company. It's always a pleasure to have these guys present. It's quite a remarkable direct lithium extraction story out of Argentina, strong strategic alignment with Lilac, as well as financial commitments from various credit export agencies. And most recently, they've initiated an expansion plan to achieve 100,000 tons per year of production by 2030. That really speaks to the incredible scale of Kachi as well as its other 100% owned projects in Argentina. And with that, gentlemen, please take it away.
Thank you very much, Joe. It's always a pleasure to be here, and thank you all. If you're listening in or you're listening to this as a replay, thank you for your interest. Lake Resources main board is on the Australian Securities Exchange as ticker code LKE, but we're also on the OTC as LLKKF. We are looking to do a US main board listing later in the year. We're focused on lithium, but what we do is fundamentally different. As Joe mentioned, we're looking to produce a cleaner lithium, doing that both higher quality and better ESG outcomes. And to do that, we're using a direct lithium extraction process called ion exchange. Now, I will be making forward-looking comments, and I'll make no apologies for that. But please be aware, this will be available on our website, and it's a summary of the public presentation we made on 25th of January. We're focused at Lake Resources to produce a very high quality product. And the reason for doing that is because that's what the end user wants. Way back in 2017, 2018, the chairman, Stu Crow, who's on the line, and myself spent time in East Asia, China, Japan, South Korea, and they were telling us at the time, if you're going to be producing from a brine project, whether it's in Chile or Argentina, if you're going to be producing for a brine project, just deliver us consistent, high quality product. And then we were also found more recently, particularly out of the EU, the demand for better ESG outcomes. And to do that, you can't do that using the same methodology. So there had to be something different. We were really much at the vanguard of that. We looked at 13 different methodologies back in 2017, 2018, and we've now partnered with Lilac Solutions out of California because they're using a really well-known water processing method. And fundamentally, that's all we're doing with brines. We're not doing any mining. We just process brines, take the lithium out, and put it back where it came from. But by doing so, we can produce a product that is approaching chemical quality on site, 99.97% purity, and most importantly, low impurities. And particularly for some of the EV makers and their consumers, doing that with a lower water impact, a lower land use. We're going to have a lower carbon footprint because we're using predominantly solar power. And that's a benefit that we get partnering with Lilac. We're aiming for production in 2024. We're in the middle of a definitive feasibility study at the moment, aimed for mid this year. This is a large scalable project, as Joe mentioned. We're targeting 50,000 tons per annum of production starting from end 2024. To put that in comparison, 50,000 tons per annum will make us an equal third largest project in South America along the big guys. And the reason we can do that is because we've got indicative, long-dated, low-interest debt funding from the sovereign states of the United Kingdom and Canada through their export credit agencies, and also because of the sheer interest and demand that's coming from potential off-takers to then support that going forward. So our aim, as Joe mentioned, is to be an independent producer at scale. We're actually have a starting at 50,000 tons per annum from Kachi, but we have other projects. So our ambition is to be 100,000 tons per annum by 2030. And we can do that because this is a scalable process. It's modular. We've had a lot of learnings from our Kachi project, and we can roll that out on the next ones. So first of all, let's look at our Kachi project and the current definitive feasibility study that's underway. We did a PFS back in 2020, and we updated that, refreshed it in March 2021. We're using a great firm that I'm sure you all know, Hatch. they are excellent, and they have been very favorably predisposed towards looking at new extraction technologies. We had been looking during last calendar year at perhaps doing a separate study alongside to look at a phase 2 to move up to 50,000 tons per annum. Now that is embedded as our base case. And that's going to make us a major producer. Just on the ASX alone, if we were producing at that today, that would make us the largest lithium producer there on that bourse. This is a quick mock-up in 3D as what it will look like. I just want to focus here on the right-hand side. That letter A is essentially the warehouse with the ion exchange modules inside it from Lilac. That replaces 20, 30, maybe even 45 square kilometers of evaporation ponds at this 50,000 ton per annum target. And instead of that, we've got a footprint the size of 1 or 2 city blocks. So this process is pretty simple. If you get a chance to talk to Joe or Dave Talbot, they'll talk to you about ion exchange. It's not new. It's been used now for more than 70 years. It's widely used in the uranium processing sector, and all we do together with Lilac is adapt that for lithium. It hasn't been used before because it really hasn't been an economic driver to bring new technologies. But now that lithium prices have gone from $6,000 to $9,000 a ton to currently trading between $35,000 and $60,000 a ton, there's an economic driver to do this better, to maximize your resource, to produce high quality product, and to do that efficiently and cost effectively. All we do is pump out the brine, and instead of putting an evaporation pond, it goes into a tank or a module. Those tanks inside have ion exchange beads, which are like grains of sand. The bond is ionic, so it looks for the lithium and bonds onto that ionic. That's an electronic, an ionic bond rather than chemical. And because of that, we can actually strip out between 80 to 95% of the lithium in less than 2 hours. And then that brine without the lithium in it can just be returned back to its source. So this is a great environmental solution, and also maintains a water balance in these hyper-arid environments. So then inside that tank or module, you've got those beads with the lithium bonded on it. We strip that and produce lithium chloride in a single step. And then those beads are available to be used again. We just do this over and over again, 24/7, every 3 hours. And it produces lithium chloride that goes into a traditional back into the plant, like I showed you in that 3D mock-up. So not too much different in the flow sheet. The bit that's new is really a pretty well-known technology, just adapted for lithium. And naturally, when there's anything new, people get concerned. That's entirely understandable. The trick here is just to do test work. We've characterized this brine. We ran 18 months of benchtop work with Lilac. We're coming up to nearly 2 years now of running the pilot plant in California. And now we're going to have a demonstration plant on site demonstrating how this works on site at scale with high quality. And I think that'll be a key kicker. Lilac is good in that they've got significant financial backing. It's important to have a good technology. It's important to have a good resource for it to work on, but that technology partner also has to have good backing. And they've been backed by the Bill Gates-led Breakthrough Energy Fund, MIT's the Engine Fund, some well-known investors from Silicon Valley, plus participants in the supply chain, BMW, Sumitomo, SK Materials out of South Korea. And together with that, we aim to deliver on a number of sustainable development goals and make a meaningful impact in lowering the carbon footprint and also delivering better social outcomes because of the lack of evaporation ponds and not evaporating all the water up into the atmosphere. If we take a change now and we look at the financials, the pre-feasibility study that we refreshed March last year was based on a backward-looking price of $15,500 a ton. And it was also done, as I mentioned at the start, at 25,000 tons per annum. Now it's going to be at 50,000 tons per annum. So at 25,000 tons per annum, the capex was $540 million, a cash cost in line with others in the brine space, and an annual EBITDA line of $260 million. Well, naturally, if you double that production, that EBITDA line is going to be double. The capex line won't be double. Capex could be 1.6, 1.7 times. Some brokers have come out with some estimates. We haven't come out publicly with those numbers, but look, it's going to have a 9 in front of it. But the great thing is, if you put in even the low end of current lithium carbonate pricing, let's say $30,000 a ton, this is producing an annual EBITDA line that's approaching $1 billion US a year. Now, that's more than our current market cap, and we're going to be doing that in cash flow on an annual basis for more than 25 years, and that's just on the first project. So this really does become a major cash producer. And the reason we're so confident about it is that Lilac and Lake have worked a lot on the processing, so we're comfortable with that. Hatch are very comfortable with the process we're adopting. But furthermore, we've got the demand with off-takers and the financial backing. The UK Export Finance Group and Canada's equivalent, the EDC, have provided expression of interest for 70% of the total finance here. We went back to them looking at a 50,000 tonne per annum rate. Look, that debt will be somewhere around 670 million, and they're good for that. That's 11-year debt or 8.5 years post commissioning, and it's going to be priced at current prices, if we did it today, all in under 3%. That's pretty exceptional, and I'm not talking 3% above LIBOR, that's 3% all in. And so we can really make the project sing thanks to that sort of support. This is in our indicative project production timeline. This may be changing slightly now that our DFS is upsized. It may not be Q2, it might be a little later in the year, but certainly the ESIA should be out Q2, and that will then trigger the debt financing. Separately, the demonstration plant should be on site in Q2, and that will produce large samples for off-takers. And we're still targeting construction at the end of this year for production commencing in 2024 and probably at full rate in 2025. If there are some changes, that we'll be updating the market, but we're looking at all sorts of ways where we can do things in parallel and still meet that sort of timeline. So if we look at where we're situated in the lithium triangle, Argentina and Chile, it's interesting, Argentina is now looking more favorable amongst investors. Our Cachi project is literally down the road from Livent. They've been operating there for the longest time, since 1997, listed on the New York Securities Exchange. They've got a 4 to 5 billion US market value, and they're producing 16,500 tons per annum. We're going to be starting at 50,000 tons per annum, so it's pretty easy to do the math there. But we have 3 other projects, Cauchari, Olaroz, and Paso, and these are alongside our current companies. At Cauchari, we've got Lithium Americas with Ganfeng. At Olaroz, we have what used to be known as Orocobre, now known as Allchem. We started drilling at Olaroz in the last 6 weeks. Cauchari, we drilled back in 2019. We've demonstrated very high quality brines here. And this is going to be part of our target 100. That's 100,000 tons per annum production by 2030. Because we can actually cookie cut and utilize our learnings in the PFS and the DFS at Cachi, we can roll out a lot of that into the next project, bring it to market more quickly. What we have to do is pump the brines out and get them characterized and demonstrated with direct lithium extraction. And we can probably come out with a resource at the same time as a pre-feasibility study and get the next project going. The off-takers are looking for it. The debt financiers are keen to try and support us onto the next one. So that's going to make a significant difference. Just quickly on the capital side, we've got a share price just under $1 Aussie. That's about 70 cents US. Market capitalization of about 850 million US. We've got 70 million Aussie in the bank at the moment, and we expect to add about 65 million to that come June. You see there those listed options. They come due in June, so that'll be another 65 million into Treasury. Our partner Lilac is looking to provide 50 to 70 million US towards the project. An off-taker will probably provide some money towards getting this going. So there may be a shortfall of, say, 50 million US come mid-year that we would need to get from the markets, but this isn't a stretch. We've got most of what's needed to bring this to market. On the team, we've spent a lot of time recently on actually building the owners team in country. Gautam Parimu, you see here on this slide, our Chief Operating Officer, has been building projects in South America for more than 25 years. And what's great about him, he's got a very nuanced approach in working with local communities. We added Amalia as a director based out of Buenos Aires, who's worked in the energy and resources space for decades. Nick Lindsay, Robert, myself have all worked in Argentina, Chile in the past. Stu is very well versed in international capital markets. And we'll probably be adding people to the board and the senior team as we continue to grow. So essentially, in closing, Lake Resources is about producing a high purity product, because that's what the battery and cathode makers want. There isn't much supply around, and so those offtakes are now going to have market pricing. We can deliver that with major ESG benefits, and we aim to be a significant independent producer at scale. As I mentioned, 50,000 tons per annum from Kachi, and potentially a whole lot more from our next projects. Thank you so much.
Steve, that was great. Really appreciate you keeping that in tight fashion here. We do have a number of questions, but I really wanted to touch on valuation here. I mean, looking at the PFS, 25,000 tons a year, NPV at 748 million, and a lithium carbonate price at over 11,000 a ton. I mean, what happens at 50,000? You know, it seems like there's a pretty strong disconnect with where you guys are valued now. And that's at 50,000. There was, recent indications you guys are looking to go to 100. So maybe you could just walk us through what that looks like.
Okay. Well, look, as you know, Joe, I think the market is still catching up with the fact that lithium pricing has spiked recently. I think they're more familiar that, every commodity, it'll come back at some stage. We can't see that happening anytime soon. I can't see it under $20,000, $25,000 a ton anywhere in the next 7-8 years, because there's just no new supply there. So rather than saying, prices are roll off, you've got to use a higher price. If we put, as I said, $30,000 a ton in there, we're looking between 900 million and $1 billion US a year on the EBITDA line at 50,000 tons per annum. That means that your IRR is well north of 60%. You're looking at NPVs that are many times our market value. I mean, the fact that we could produce our market value in 1 year's EBITDA for a 25-year mine life, that's pretty unusual. So at some stage, the market's going to catch up. And I think some stage the market is going to catch up with lithium projects in general, because they using sort of backward-looking prices rather than what's happening. And that's just because we get the benefit, because we're talking to potential off-takers all the time. They need this product. There's almost now a mad scramble. Tesla's always been ahead of the curve. Some of the others are really going to struggle to get the supply that's required to actually roll out all of these EVs.
You touched on something there. I definitely want to circle to it in terms of, your inside scoop on some of these offtakes and how they behave. But, more importantly, how you guys look to expand to that 100,000 ton per year operation. Obviously, with DLE providing such an advantage on a modular approach, maybe you could just walk us through, your vision, or help us understand the vision of getting to 100,000 tons a year.
All right, so let's say we're producing at 50,000 tons per annum in 2025. That's from Kachi. We could probably expand that project again, but let's just park that one up to the side. As you saw, we've got another 2 or 3. We could potentially just have one of those projects producing, but it's probably ideal to get 2 of them working at 25,000 tons per annum each. The benefit of the learnings we've had with the work we've done at Kachi is we can cookie cut that. We can go, okay, what are the capital costs? What are the operating costs? What's the methodology here? How do we work? At Cauchari in Olaroz, there's a major solar PV farm, 2 of them just down the road, that are amenable to expanding, so we could tap that for energy. With our drilling, we basically take those brines and send it straight for DLE processing, and so we can get that test work. And that way, when you come out with a resource, you can already have a pre-feasibility study and quickly get that through to a DFS. The off-takers are looking to work with us to get the next project up and running. And interestingly, the banks are also keen. So that's how you do it. Look, it sounds aggressive, it sounds aspirational, but when you back look at this, there's a darn good chance we can deliver on this. And that'll make us a serious player globally with the only one that's producing a consistent high quality product with that ESG benefit. So that means you get preferential treatment.
That's great, Steve. Appreciate the color on that. Just circling back to the comment on the offtakes, we're seeing a real rally in lithium pricing here. Whether spot is indicative of, or even being the barometer of what's happening, it's undeniable that there's a rally here. Are offtakes waking up? Are they going to start coming in more aggressively? I mean, I'm assuming you guys have had conversations, but are they really starting to understand the necessity to lock up supply?
We've been looking for a market-based pricing mechanism for some time. Not the old days of just locking in a flat price, but something where you're looking at, say, a benchmark, a fast markets or something like that for last quarter and using that for the next quarter. Finally, late last year, we saw some of our discussions coming around to that mechanism. So that was important that there was a pricing mechanism there. The second one is that we've been asking them to actually stump up with some equity towards the head company or as a prepayment on supply. And the reason for that is that some of the offtakes that are getting signed are essentially just a free option for the future. But if they actually put some money behind it, it makes those offtakes look serious both to us and to the market. And it also helps us ensure that we can remain being independent in the future. Be that as it may, there's been a rush in the last couple of months, certainly the last 3 months, and particularly the last 6 or 8 weeks, with price spiking. I think the penny is finally starting to drop that OEMs as well as battery makers need to secure supply. They used to just say, hey, don't worry, we can do this. We'll just get it from the local hardware store. Now they're finally going, actually, we really need to get a long-term agreement. And we're not looking just to be a raw material supplier. We actually want to be embedded in the supply chain long-term as a reliable, scalable producer. When you go through the whole battery qualification process, you don't want to have 50 different providers. You just want to have a small group that you can work with long-term. And I think there's a real opportunity in this major growth phase globally.
Steve, I really appreciate that, and Stu as well. We are at a time. There's a number of questions here that we're going to relay to you guys, and I'm sure you'll have an opportunity to address some of them for our listeners. But I do want to thank you guys both for presenting here today, and look forward to the next one. Appreciate your time, gentlemen.
Thank you so much.